Greetings. My name is Craig Saddlemeyer. I work for the Raise-Op Housing Cooperative. I've been a part of the Raise-Op since 2008 as a resident and member. Today we're going to talk about how to start your own housing cooperative in Maine. A lot of what we cover is probably applicable to other states as well, but each state has its own rules around forming corporations, so expect some amount of variance from state to state. This is an image from our 2019 annual member meeting. Our members gathered together each year from all of our different apartment buildings to elect the board of directors, which is made up by a majority of our members. That is, the board is made up by a majority of members, and our members take turns serving on the board each year and directing the business of the housing cooperative. We consider our project a community organizing effort. There's two general ways to approach developing housing cooperatives. One is more of a traditional developer role where you pick a building and you establish what basic market demand is, and then you develop a building and then find people to go in it. In our case, we have approached it as a community organizing effort, meaning that we being grassroots impacted folks in our neighborhood, in the Tree Street neighborhood of downtown Lewiston, where there was substantial barriers to good housing, lots of deteriorated housing, a lot of neglect, a lot of challenges with bad property management. So we got together some community leaders that wanted to see things change, some of whom needed housing for themselves, and we organized a housing cooperative from the very ground up, using the leadership of those people to inform basically every decision made throughout the project. So it's a very different model, but it truly is a grassroots organizing model, and so that's our experience. That's our point of reference, and just take that into consideration as you view this slideshow, because there are different ways of developing affordable housing, and the way we have done it is more unique. Today we have 15 apartments co-op-wide that are home to 50 residents, and that's spread over 3 apartment buildings. These are 2 of our buildings on Maple Street. All of our buildings are 100-year-old triple-decker, classic New England triple-decker buildings. We've renovated the apartments, so you have some examples here of some of the renovations we did. This was to a building in 2017. So they've got a lot of charm. They also got a lot of 100-year-old building challenges, but that is what we've had to work with. And then these are properties that we own on Pierce Street in Lewiston, the 9-unit apartment building on the right, and then our office that we share with another community organization on the left. The office is used for board meetings and house committee meetings, and office space for staff as well. Because we are a scattered site housing cooperative, meaning we own multiple buildings, all under one cooperative corporation, we have a structure that allows us to manage this in a democratic way. So each year our members elect the board of directors at the annual meeting, as you saw the photo in the beginning. And the members, having elected the board of directors is really making most of the management decisions, binding corporate decisions for the organization. This can include hiring and supervising staff, when to buy more property, when to take on debt, what policies to create. That's where the officers of the corporation serve. And we make sure to have at least one representative from each building on our board of directors. We are allowed to have some community volunteers, that is, non-residents of the co-op, serve on the board, but they must not exceed 1/3 of the board. So 2/3 of our board of directors must be made up of members who live in the co-op. The board of directors forms committees, and this includes house committees. So each building is effectively a house committee of the board, where they make some important decisions about their operating budget, maintenance needs, special building rules specific to their property, and just kind of really develop their own culture at each building. So we try to take a lot of the administrative burden of operating one zone housing cooperative out of the way for people, and provide a lot of technical support. And then each house committee has a fair bit of discretion in how they operate their buildings, but the board of directors still has ultimate authority, and if can override a house committee's decision if it believes that the house committee has not made a responsible decision. So as some reference point for affordability, fair market rent in 2021 for a 3-bedroom unit in our market was $1,214, and for Raise-Op in the same year, our carrying charge, which is what we call rent for a 3-bedroom unit, was $785. And that includes the same things you'd see included in rent: heat and hot water, and taxes and insurance, and debt service, and other operating needs. So pretty good savings there for an occupant of a 3-bedroom unit. And what we find is that you really see these savings increase over time as the housing market heats up. You see inflation. So here from 2014 to 2017, average rate increase of rent in Lewiston was anywhere from 10% to 35%. Over that same period for the Raise-Op, the increase was 5%, and that's because we're just increasing our carrying charges based on our operating costs, whereas the market, most property owners are increasing rent based upon what they can get for it, based on increase in demand. So by just operating at cost, we're able to keep the costs lower for our residents. And this was consistent with just what the rate of inflation was over that same period of time. And that's one of there's a lot of benefits to being in the co-op, but that's one very direct one that I think most people who join a co-op are interested in, is in realizing financial savings. So the truth about co-ops is co-ops are not utopias. Co-ops are living democracies that reflect the values, abilities, resources, and circumstances of their members. All of those are really important variables. You can have good values and even good abilities, but if you don't have the resources or circumstances that would support the development or operation of your co-op, then you'll face challenges. And also you could have resources and you could have favorable circumstances, but you might not have the values or abilities to make it work. So we just want to make sure that folks understand, have realistic expectations of what a housing cooperative can be, and understand that it's just it's a tool, it's a structure, and there's a lot of different variables here that are going to affect to what extent it's successful, and success, of course, is a very subjective thing. So there, like anything, there's rewards and risks of being a part of a housing cooperative, and they're similar in some ways and different in some other ways from other housing arrangements. So here's a quick review of some of the major rewards and risks of being a part of a housing co-op. So rewards, you benefit from financial savings. As we just noted, there's no third-party owner taking profit out of your co-op. So the members are either investing the savings to improve their quality of life at the building, or they are passing on those savings directly to their residents. The risk on the other side is that when there's financial deficits for the co-op, residents will feel that as well. So that may mean increases in rent. That could mean deferred maintenance, maybe lower quality of services or quality of life because you don't have the money to pay for those things that you want. A reward, you have more control over your home than, in general, we're comparing this to renting because it's typically renters that would be seeking out the housing cooperative model. Not exclusively. There are some homeowners that may be interested in it as well, but certainly, especially in where we are operating, where traditionally the cost of owning a home has been low relative to other markets, it's typically renters that are joining our organization. So you have much more control over your home than a renter would. You have a sense of permanency. The co-op's not going to arbitrarily evict you because it can sell the building for money, as we see happening at this particular moment during a really, really hot housing market in Maine. Because the co-op has no incentive to do that. Its mission is to keep you housed affordably and safely and comfortably. But you also have more responsibility for your housing conditions. So you don't have a third party to blame for the way the property is managed or for the ownership decisions. You're a part of that. And if you, for example, cause damage to your unit, you're not passing on the costs of that damage to someone else. You are going to feel those costs to repair those damages yourself, as are potentially your housemates. Another reward is it's a democratic system, so it's inclusive, or at least it's designed to be inclusive. And democracy is also slow, and there's opportunities for conflict. Again, comparing to a rental situation, pretty much all traditional for-profit landlords do not operate in a democratic way relative to the tenants. The landlord will make the decision, and the tenants can comply or they can move out. And that's basically a dictatorship form of decision-making. In a democratic form of decision-making, people are included in the decision-making process, but that process can be slow, so a decision might take longer to get made, even if it's an urgent one. And there's also, because you've got more chances for people to say what they think, and more chances to disagree or debate a solution to a problem, that means there's more opportunity for conflict between the neighbors. There's an opportunity to form friendships in the organization. It's not an obligation. People should be able to join a co-op and not be obligated to be friends with people, and that's certainly the case for the Raise-Op. People can join and live their private lives and meet their minimum obligations as members to participate in making decisions, but there's an opportunity there to form some very deep social bonds with people, which many of our members do. And then the risk of that is that friendships can complicate management if these are the same people that are making management decisions, where there are strong friendships in some cases and less strong friendships in other, particularly friendships that have gone badly. All of those things can complicate how a property is managed. In general, I would say, the net effect is that friendships deepen people's commitment to keeping their neighbors housed safely and affordably. So the net outcome should be positive, but again, it can complicate things. Another reward is that people participating in the co-op learn new management and finance skills. They can learn potentially maintenance skills, what it costs to run a building, how to develop an operating budget, what kind of fees and filing requirements there are, and just how to maybe organize something like that themselves or operate a lot of transferable skills are learned to other nonprofit corporations. So you're learning, but you're also, if none of you are professionals at this, then not having those skills could also create problems. As you go along, you have to make decisions about whether it's appropriate for you to try to do something yourself or hire a professional to help you. Of course, professionals cost money. And if you too often don't hire the correct professionals, especially licensed ones, to work on your heating system or plumbing, and you try to do too many things yourself without the skills, then that can create some problems that will actually make the condition of your housing much worse than you had planned on. Another reward, this is sort of similar to point 3, but you have the opportunity to really promote social inclusion. You can be intentional about how you set up your housing co-op to really not just technically comply with fair housing law, but really embrace the spirit of fair housing rules, to reduce barriers to people who typically face discrimination in housing based on their race or their ability or other social status. But at the same time, housing co-ops can potentially create social exclusion, and it's certainly the case that there are examples of housing cooperatives doing both. There are some housing cooperatives that are very inclusive, and I would hope that that is the case for a majority of them. But there are some housing co-ops that are for, specifically for very wealthy households, and put a lot of barriers in place to folks that don't fit the certain social categories that they would like to have in their organization. And that can happen. Exclusion can happen by intention or by accident. So that is another risk. And lastly, another reward is that, the members of the co-op can achieve more when they work together. They can accomplish things that they wouldn't be able to do isolated, especially as renters, and really all benefit from those accomplishments. And then the risk is also that there can be, when you're all working as a group together on something, there's a risk that there's a diffusion of responsibility when no one as an individual feels like something needs to get done. If it's a hard thing, maybe nobody does it and it just doesn't get done. So you can achieve more together, and you can also kind of procrastinate together. Whereas if it were one person's responsibility, they might feel, it might just be more clear to them that they need to get this done. And of course, in a landlord situation, they have the motivation of personal profit, so they can understand both that it's their responsibility and the direct connection between their personal financial gain. So this is obviously, we feel that the rewards when a co-op is done correctly far outweigh the risks. But they're all there. They're important to be aware of when you are starting your housing co-op and creating rules and making plans for how to operate your cooperative business. This is a community garden that we created. It's just one example of something that the co-op, our residents were able to do together that they would not have been able to do most likely without the co-op structure there. So there was some vacant land next to our buildings. We did not think it was being put to the highest and best use for the neighborhood. It was kind of abandoned. It wasn't well maintained. A lot of our residents at this site, they didn't have any green space of their own. They wanted to grow food. The co-op was able to apply for some grants to bring in community partners, to bring in lots of volunteers, and the neighborhood turned out. We built these beds together. We purchased the lot, and with partners developed this community garden that's managed by another local nonprofit organization. And our residents have the opportunity to grow food in some of the beds, but it's also available to the neighborhood at large. So this wasn't just a victory for our residents. It was a victory for the neighborhood in general, so that they can also have the opportunity to grow some food for themselves and just make this corner of the neighborhood look like a nicer place, a cozier place where community is being developed. Okay, so getting more now into the technical aspects of starting your own housing cooperative. So a really important question at the beginning of your process is, who will this co-op primarily serve? Again, we're talking about, whether you're doing this as a traditional affordable housing developer and you're just looking at this in terms of a market study, or whether you're doing this from an organizing perspective and you are really asking the question of, like, who are we trying to help? Who are our leaders in this project? Who are the constituents that are most impacted by the work we're doing? Who will this co-op primarily serve? You have basically two options, and of course there's lots of groups that you can serve, but the way I'm framing this is to help you make a decision about the corporate format that you want to pick. So to pick the correct corporate format, there's two basic options for you here. One is you are looking to serve very low-income households that have little to no savings or access to capital. So they don't have, they have very little money in their bank account. They don't own other things worth money that they can trade in for cash. That would add up to anything approaching an investment in the property. Or you're looking to help low, moderate, or even middle income households that have capital that they could invest in this new housing cooperative. $5,000 or more is a ballpark figure for what might set them apart from the folks in category A. Another way of asking the same question that it's getting at is, do you need capital or operating subsidy to start your housing cooperative? Or will investment from the residents combined with loans that you take out from lenders be able to pay for all of your capital needs when you start your acquisition and renovation or other development needs? So the answers to those questions will inform whether you want to start a group equity housing cooperative or a limited equity housing cooperative. A group equity model is where there are savings, you're using them to lower rent. You can collect security deposits, comparable to what people are collecting for security deposits elsewhere. And you can kind of use those security deposits as savings accounts. You can even have people pay into them more over time if you choose to. You would incorporate, I would recommend, as a nonprofit organization. You can be eligible for 501c3 tax exemption status if you apply for it from the IRS, which will be very important in order to raise the capital you need from grants and donations and loans. Of course, anyone can get a loan, but if you need just subsidy, if you need money that you're not going to pay back because your members don't have the money, and banks, most lenders, of course, are not going to lend 100% loan to value on a property. They want to see some other equity in the project. Then you're going to need grants and donations to make this affordable housing. And this model is basically recommended for very low-income residents, especially those without startup capital to invest. This is how the Raise-Op operates today, but we have also been a limited equity housing cooperative. Technically, we're incorporated as a limited equity housing cooperative, but we have 501c3 tax-exempt status, and we operate under the group equity model. So there's no earnings, no profits that our members are making on their investment in the co-op. And what they've invested in the co-op is, financially speaking, symbolic, so small that it's just symbolic. They just own their member share, and it just costs a flat $10 that will never increase. and that's the group equity model. They're not going to earn anything on their shares, but they do get the lower carrying charges, the savings invested in the property, authority to make decisions about what to do with savings. So those are the things, those are the benefits of the group equity model. In the limited equity model, savings can be paid with some limits, because it's limited equity, to members in the form of dividends on their investment. This type of co-op would incorporate as a housing cooperative. In Maine, it's a cooperative affordable housing corporation. Or they could also incorporate as a similar type of shareholder corporation and just import as much of the housing co-op model as they want. But it might be technically under a different corporate structure. And if you're in a different state, you can, if your state doesn't have a statute establishing the grounds for an official cooperative housing corporation, you can form some other corporation that, again, just brings in all of the bylaws, all of the articles that make a co-op what it is, and you can still work that way. So a limited equity housing cooperative, under most circumstances, is not going to be eligible for nonprofit status, for 501c3 nonprofit status. And that means that if you get grants and donations, they're going to be taxed as income, and that's important to plan for. In general, it will be hard to get grants and donations because if you're not a 501c3, then the grants and donations that the givers are providing, they will not be able to count those as tax deductible for their purposes, and some organizations will only give to 501c3s. But even if you do convince anyone to give you that subsidy, it is going to be taxed as income. So you need to be prepared for that in your financial modeling. So most of the startup capital for your project is going to come from the members who invest in the co-op, in combination with loans that the co-op takes out to pay for their capital needs. So the Raise-Op Housing Cooperative started under the limited equity model when we were just some folks not having any experience with what we were doing, and not being really not as growth and mission oriented as we are today. Just wanting to provide some housing for ourselves. So we started just as a member-managed limited equity housing cooperative, and then once we decided we wanted to grow and become more mission-driven, inclusive, and have more of an impact in the neighborhood, and realized we were going to need a lot more resources, a lot more money, and staff to make that happen, then we shifted to the group equity model and the nonprofit status. And the terms, what group equity means is that the organization, as your organization increases in value, the value is retained by the cooperative corporation. And so the people benefit from that equity by being a member of the group. The equity can be leveraged. For example, you can borrow against your equity, maybe to do improvements on the property, or you can borrow against the equity to develop a new project. One way or another, you're leveraging the equity for the benefit of the group. In the limited equity model, you're doing that too, but there is a certain amount of return on investment that can be made available for your members. The limited equity model might work for very low-income residents if they have a rental subsidy somehow for everyone that can pay the operating costs, and then maybe you can take on more. The project maybe can take on more debt because people can afford that extra debt because they've got that rental subsidy. But that it's possible. I'd say those examples are more narrow, and for the most part, the two options that I've laid out are best for the groups that we've established in the previous slide. So the rest of this presentation is going to talk about the limited equity model, because typically this is the model that we are asked to consult about most frequently, and it's also the one I think most of what I cover in the limited equity model is in many ways applicable to the group equity model. You just have to remember the key differences about the group equity model can get grants and donations that aren't taxed as income, and that in the group equity model, members are not going to be making a return on their investment in the form of dividends or patronage refunds. But a lot of the information here will be transferable. All right, so the next sort of important early questions to ask about your project is who will govern your housing co-op? Will it be governed by members or a board of directors? And the main logic that would drive this decision is that if the co-op is small, then like 6 members or less, then it probably makes sense to just be governed by your members, because 6 is like a manageable group of people, and having a board of directors elected by just 6 members is a bit redundant. Whereas if and that's how we started when we were basically we were 6 members in our 3-unit building, and we were member managed. We had no staff. The board of directors was not separate. Today we have 15 units and 50 residents and 15 voting members. So we have a board of directors that is smaller than that. The board of directors right now has 7 directors serving. So it's that smaller group of people. It's more efficient at making decisions. Gives members a chance to take turns serving on the board instead of always serving on the board. And of course, these members are also still serving on their house committees and meeting regularly as a house committee to make decisions there. So it's not that they're absent from decision making, but the board is doing some of the heavier lifting while the members just focus more on their individual homes. And then another decision to make is what is required to pass a vote. Are you going to decide things by a simple majority, a 2/3 majority, or consensus? Raise-Op uses simple majority. I would advise against consensus. I would advise that consensus should be a goal, but not a requirement of decision making, especially if you're going to do anything bigger than just a small member managed co-op. Maybe consensus makes sense if you've got like 3 members and that's it. But as you start to get bigger, it's just important that you can make decisions and not get stuck in a stalemate. And consensus can lead to that. So continuing to talk, so now we're going to get into the shares of stock, which is a defining feature of limited equity housing cooperatives and something that folks usually have a lot of questions about. So for this example, I'm proposing basically that a share of stock is going to be worth $5,000. That is considered the par value for this sample housing cooperative. So the par value is the starting value of the share. And we've got 4 founding members that are going to start this housing cooperative together. So each member is going to buy at least 1 share of stock. And in this example, I'm going to talk through a situation in which members are allowed to buy more than 1 share of stock. So we've got 2 members here that have each purchased their individual shares for $5,000, and then a third that has purchased one for $10,000, and a fourth that's purchased 3 shares totaling $15,000. And if you have the choice, I would recommend that it's just, each member purchases 1 share or an equal number of shares. The more you can keep things equal, the better, because the more ownership stake someone has in the co-op, the more power they likely will have, and you want power to feel as equal as possible in a co-op. But capital can be hard to come by. And if you've got one person in the co-op who's got more money and they want to somehow contribute that to the organization without just making a donation of that money, then giving them a chance to invest more can be a way to put that money to good use in a way that's fair to them. So they can purchase more shares of stock and own a greater investment in the co-op, and then you can use that money to develop your building, and that's less, the benefit to the other members is that that's less money you have to borrow, and therefore less debt you're taking on, less interest you're paying on that debt, and everyone benefits from the affordability created by that investment from the folks with some more money. So here you go. They're each buying at least one share. The folks with more money are buying 2 and 3 shares. And you can see how much money that adds up to when you've got $5,000 per share. And that reflects the ownership of the co-op. So this co-op has 7 shares total, 4 members owning this housing cooperative, this legal corporation that they've formed in the state of Maine. And based upon the money they've collected from their share sales, they have $35,000 of startup capital. Now, decision making in a cooperative, and this is very important, is owners are the exclusive members of the co-op, and even though some may own more shares than others, the principle of the co-op is one member, one vote. It is a democracy. It's not a plutocracy. Owning more shares does not get you more votes in the cooperative. Everyone gets one vote. Those votes add up to the decision according to whatever governance rules you chose in the beginning. But the person with more shares should not be advantaged with more votes, and that's just a democratic principle that's important to maintain. I think we covered this question. Okay, so with your capital investment, what do you do with it? You use it to purchase real estate, land and buildings. You use it to improve that real estate, which is a capital improvement. And you can also put that money into a capital reserve, so a special savings account that you only access when you want to make investments in the property that really improve it or replace capital items that have reached the end of their useful life. So use your capital reserve to replace a roof or replace a boiler or replace your siding. And that's not to be confused with smaller maintenance things like, a toilet that you replace or a floor that you refinish or, some lights that you replace. Capital reserves are really preserving or enhancing the value of your property, the life of your property, and maintenance is more of just the annual repairs. So I recommend basically as a rule that your shares should never exceed the market value of the total assets. The co-op has some discretion over what they put for share values, especially at the start, but you don't want your share values to exceed what you could trade all your assets for in cash. So between what you've got in your bank account and what you own, if you were to liquidate all of that, you want to be sure that you can pay people what they deserve for their shares, say in the event that the co-op is dissolving. If you exceed that, then, that's not good. We'll leave it at that for now. Hopefully it's obvious why that's not good. Co-op can be used in a multi-unit building, which is what the Raise-Op has. You could also purchase one or more single-family houses with the co-op model. You could purchase multiple houses and each person lives in their own house. Or you could purchase a single house and have members occupy different bedrooms in that house with shared living spaces. There's a lot of complexity with shared living space. I should just say it's an added layer of complexity to have shared living space. If you pursue that kind of collective living situation, just be aware that social inclusion is harder because people have less privacy, which means that they need to have similar lifestyles and habits in order to cohabitate successfully. Whereas the more privacy that people have in terms of having complete living units with their own bathroom and kitchen and living room, and the more space they have to themselves, the more they can live their own life according to their own cultures and values and personal living preferences, and have neighbors that may have very different lives from them. And that separation, that boundary being maintained allows for that privacy and that difference in lifestyles. Whereas the more overlap there is, the more shared spaces there are, the more those lifestyles can come into conflict. And it can just mean that fewer people can live in your housing co-op if you pursue that route. Apartment buildings are always going to, if your goal is affordability, apartment buildings are always going to be more affordable, both to develop in terms of acquisition and renovation, and especially as far as operation goes. Single family homes, even if you can get them for a good deal up front, are going to be prohibitively expensive, again, from an affordable housing perspective, if you're housing very low-income people. If you're looking at more moderate or middle-income people, households, then a house may be an option. So you've got your 7 shares, you've got your $35K of startup capital that you invest in your housing cooperative. So now the housing cooperative has that $35K. You're going to borrow or lease the building for the purchase price minus your down payment. So you've got $35K for your down payment, so you got to borrow the rest. And the numbers I put on the buildings here are just, that's not what you can get those structures for anymore, honestly. But for the sake of example, we're just saying, well, one house costs $130K, and an apartment building, it's $60K per unit to house our 4 members. So anyway, there's 2 scenarios to make your co-op get off the ground from a financing perspective. The more conventional one is the co-op takes out a loan to purchase the property. So in that scenario, the co-op buys the property, the lender is financing it, the housing co-op is paying a loan premium plus principal and interest to the lender, and the lender has a mortgage on the property. And that's traditional commercial financing, or traditional homeowner mortgage financing model. A second scenario is a lease to own arrangement, which you might do if you can't gain the access to the financing you need to purchase the property outright, or maybe the seller is only interested in this option, or maybe you don't want to. Maybe you're not sure if you're ready to own the property and you want to explore that and you just want to lease to own it first. But in any case, lease to own in some cases is an option, and in that case the seller continues to own the property over a period of 5 to 20 years, whatever the lease to own term is, and the co-op still probably makes a down payment and is paying they're paying a lease rate, and that lease rate includes payments towards the purchase itself, so that at the end of the lease period, the co-op has finally finished all of their installments and then becomes the owner of the property after that 5 to 20 years. Co-ops have used both models, and both are an option, but again, it's going to be fewer. The lease to own is a more unique situation, and it may be harder to get people to agree to that option. And the seller may, in the background, is just something to keep in mind. There may be a lender the seller may still have a mortgage on the property, and so the seller needs to be paying their premiums to that lender, because if they don't, then it's going to affect them and it's going to affect you. So you want to make sure they're in good standing with their lender. So each month, folks are paying their rent to the housing co-op. So the members, in addition to owning their share and having an agreement with the co-op as in terms of what it means to be a member, they have just a regular lease agreement with the co-op, and they pay monthly rent. And you can really put whatever you want in rent, but traditionally it's got all the usual stuff: the heat, hot water, insurance, property tax, maintenance, waste disposal, contingency, and debt service. So our 4 members are paying their rent to the housing co-op, and the housing co-op is paying a loan premium to the lender. So the principal and the interest is getting paid to the lender for the property. And in the lease-to-own scenario, it's virtually the same thing, except instead of a loan premium, they're paying the lease payment, which includes a payment towards owning the property. And if folks pay early, make early payments on their loan, or make early payments on their lease, they can own the property. In the lease-to-own scenario, they can own the property sooner. And in the scenario 1 with the loan, they can pay down their debt faster, and potentially, owe less interest, and just finish paying off their mortgage sooner. Sometimes there's penalties for early payment that would be negotiated at the time that you settle your agreement with the lender or the seller. And if you default on your loan or your lease payments, the consequences are similar. In scenario 1 with the loan, the lender can take the home through foreclosure, which is a costly and difficult legal process. Scenario 2, the seller is still the owner, is basically still the landlord, even if even if the co-op has a lot more of the managerial decisions to make for their organization. The seller is still the landlord, and if members default on their lease, then the seller can take the homes through eviction. So a little bit less protection in the lease-to-own scenario. So when you pay rent, other things that you're paying for in addition to the lease payments or the loan premiums is property tax, insurance, income tax, other costs. Talked about that already. So when there are savings at the end of the year, and again, we're going to use this scenario where now our members own 11 shares total, and at the end of their annual operating year, they have $3,000 savings, so they need to decide what to do with those savings. I would recommend that a certain amount of savings get invested in reserve accounts, invested in improvements to the property, but whatever amount is left over that the members choose they want to return to themselves, they can basically divide those savings equally, and then reallocate those savings to each shareholder based on the number of shares that they own. So in this case, we have $3,000 divided across 11 shares, $272 per share gets returned to each of them, and then you see how many shares they own corresponds to how much total return they're getting, how much dividend they're earning on their investment. Now again, this is in a housing co-op where the residents are their own customers. This isn't really profit, it's just savings that's getting returned to them. But it's getting returned to them. It is it's profit in the sense that the person with more shares is making more than the folks with less shares, and they're getting that because they invested more. if everyone just owned 2 shares or the equal number of shares, then everyone would be getting the same amount of money. So there is some, when folks own different share amounts, there is some amount of money to be making from one's housemates for one's greater investment. But in general, this money is not coming from, you're not making this money off of other renters or really from anyone outside of your organization. It's all just coming from within your organization, and you're deciding how to fare equitably, reallocate those savings. So they're called dividends, or patronage refunds is what we call that money when it's returned to the members. So there will be a time when you need to sell a share. And when you're setting up your co-op, I highly recommend that you think a lot about what it will look like to transfer the share and who will want to live in the co-op after you. That is, if you are setting up a co-op to live beyond the interests of the founding members. If you have 4 members that start a co-op and you decide, once these 4 members move out, we're just going to dissolve the co-op and it's just meant to serve these 4 people and that's it, that's fine. That's just something to keep in mind. And you probably, if that's the case, you might want all 4 members to move out simultaneously, or else some of them will become tenants again when you sell the property. But in most cases, folks want to see housing cooperatives continue to survive even when the founding members move out, and over time all of the founding members will move out. And you really, when you're designing your co-op, want to ask who is going to live in the co-op next. What is going to be desirable about the co-op to that next person that moves in, because they won't have the same excitement most likely that the founding members had of just like creating something, and this is our creative project and we're just super bought in because we've been here from the beginning. What is that new member coming into the co-op? What is their motivation to join? What are the other housing options in your local market? Because as we have established at this point, I think being a part of housing co-op is work. It's more work than being a renter. It's maybe not the same level of, in some ways it can be more level of work than owning a single family home. And in other ways less so, but it requires a commitment. And you need to ask, are we creating something that is going to be of value to enough other people that someone's going to want to buy our shares? So another way of framing this question is, are your shares actually going to be worth what you say they are to future members? Because there's no guarantee. In the Raise-Op's case, our share is only worth $10, so there's a very high likelihood people are always going to want to be interested. It's, $10 is worth it to join our co-op. But again, we're the nonprofit model. In a limited equity model, can you sell your shares for what you think they're worth to someone? And you need to take into account what that someone wants, and how valuable is your housing project relative to the other places they could live, either as a renter or homeowner. And if they decide that they can live other places, they can pay less money for other places, or they can pay a little bit more money for a lot more control over their living environment, then it might be hard to sell your shares for what you think they're worth. So very important to keep that in mind when designing your co-op. So now walking through the scenario of when you sell them, we've got our old member, our outgoing member, is going to sell. They have 2 shares to sell. They're going to sell them for the increased value to the new member. And remember, in a limited equity housing co-op, you will write in your bylaws the formula for what the increased share value is. I think one simple way to do it is just say they adjust for inflation each year, once per year. On January 1st, the shares will increase according to whatever the latest consumer price index says inflation was relative to when we set the par value of the share. So you look at your date for the par value, you look at consumer price index according to like the Bureau of Labor Statistics calculator on the day that the shares are getting sold, and then that will tell you what that original amount of money is worth today. So what your original $5,000 in this example is worth at the time of sale. The housing co-op must approve the sale of shares. So an old member cannot just sell the shares to anyone out there. The co-op must be able to approve that sale. And typically the co-op has a right of first refusal to purchase the shares. So again, continuing with the scenario, the old member is selling to the new member the shares for $5,300 per share. They originally purchased the shares for $5,000 each, so they're making $300 per share or $600 total, but they're receiving in $10,600. $600 is the profit, but the $10,000 is what they paid initially for their shares. And the new member is now the owner of those shares. In another scenario, you've got a current member, and the one on the bottom is mislabeled. That should be the new member. But This is correct. I misspoke. So we've got two members who are both currently members of the co-op, and one just owns more shares than the other. So one owns 4 shares, one owns 2 shares. You can oversee the housing co-op can, oversee the process where one member is basically selling their share to another so that they can own equal amount of shares, or just the current member can buy in more. So they're selling it for that new value, and the current member that's selling is still making $300 on that share that they bought for $5,000, and the other current member is increasing their share investment, so they'll be able to make more on their investment each year, and now they each own 3 shares. So I think that's pretty clear. In scenario 3, you've got a current member that owns 4 shares, and in this scenario, the housing co-op currently has none. And the current member is going to sell their shares to the co-op instead of to another member, maybe because the co-op, in some cases, co-ops can guarantee that they will buy back a member's shares as a way of improving the value of those shares. It's the backstop. The co-op's like, if no one else will buy them, we'll buy them. Or maybe the co-op wants that current member to leave sooner rather than later, and is like, look, we'll buy your shares. Can you please go? And in either case, the current member is selling shares to the co-op. The co-op's buying them, and the co-op's buying them for using the same equation that we established before. And that's it. The housing co-op owns those 4 shares and then can sell them to one or more of the next incoming members. The co-op can terminate someone's membership. Typically, it's going to be because they violated the lease. The most common example is they haven't paid their rent or their carrying charges, and the co-op has tried to work out a resolution with that member and has not been successful. So the co-op is now asking that member to leave and terminating their membership. So they terminate their lease. The co-op is still purchasing their share back for what it's worth. The share, again, you can build into your articles of incorporation that the share can be used as a form of security deposit. So the co-op can say, hey, whatever you're earning on this share, we have to subtract some money that you owe us for unpaid rent or damages. But hopefully your members are leaving in good standing, not owing the co-op any money, and they get the full value of their investment. And then eviction, a housing co-op can evict a member in a similar scenario as a landlord and tenant if that is necessary. Obviously, not why we're doing this, but it is an option, and sometimes, unfortunately, it is necessary. So after the period of the loan or the lease is up, then the co-op becomes the full owner of their property with no more debt. And they may have, again, to help accelerate how quickly they get to that place, their members may have been buying more and more shares into the co-op. Alternatively, they could just hold on to their individual shares, not buy more shares, and just just pay on the regular schedule the debt down. But if they want to buy into their co-op because they have the money to do it, and they want to finish paying off their debt faster or their lease rate faster, then they can buy more shares to do that. So in this scenario, again, I guess we're saying it's been 15 years. After 15 years, they've been able to pay off their debt. Their shares have increased in value. And basically the value of the share has doubled since they purchased it 15 years ago. And they own their co-op. So $10,000 per share is what they're worth today in this scenario. The shares add up to $240,000, and they've got 24 shares total. No more loans or lease payments. In general, I would say expect to, yes, you can probably pass on more affordability to your residents, but it's also likely the case that you'll need to make other capital improvements or repairs, and you might need to borrow money again after you've paid down this debt, but maybe not as much as you needed to buy it, especially if you're an organization that is intending to grow. Then I'd say, you always want to maintain affordability, but you wouldn't want to drop your rent or carrying charges so low that it's a shock to the system when you need to borrow again. In either case, the residents are deciding what to do with the savings. So it's a co-op. You have the power to choose. So that is a really sort of quick and direct explanation of the basics of starting a housing cooperative. It is an adaptive model. There's a lot of different ways that you can customize a co-op to meet the needs of your group of folks that you want to house. But this gives you a basic starting point and some concepts to understand how it works, some of the history of how the Raise-Op has operated. And we wish you much luck in starting your own housing co-op. And if you are successful, however far you get in the journey, we really encourage housing co-ops to live out the principle of cooperation among cooperatives, and that you are as open source as we are about how you start, the information, the lessons you learn, and sharing that with other cooperatives so that they can develop as well, and we can continue to grow a more fair and cooperative economy. Thanks very much for watching, and good luck.